Oh, snap, we gotta bring back some holiday cheer up in here, because this is some BS. What is this crap? We get ourselves a Santa Claus arrival, and they take it right back. Just when we thought we had something, gone. Well, let's find out what kind of punishment, beating, rug pull, whatever you want to call it, the Federal Reserve has in store for us now. They've got to massage the messaging. And guess what? I'm going to set this up very, very simple for you. The Federal Reserve, in the minutes that they release in 4 minutes, need to message or massage to us what they want in terms of rate cuts for March. It's that simple. Right now, there is a 70.5% chance we get our first 25 basis point cut on March 20th, 2024. If the Federal Reserve does not want that to happen, they won't mention anything about rate cuts. And if anything, they'll just talk about hiking more. The minutes are essentially a manipulation. We know this. This is all fugazi. Okay, it's all a game to try to make us do what the Fed wants. The Fed doesn't want to surprise markets with a surprise rate cut, because that might imply something's wrong. But they also don't want to over-tighten. And as inflation is trending down, multivariate core inflation for services ex housing sitting at 2%, 2.04% annualized. There's nothing left, basically. You've got deflation in goods. Winnebago trailers are down like 8 to 15%, for goodness sakes. Even Olive Garden can't raise prices. And they're trying to explain their value so heavily that they're walking around in Olive Gardens prioritizing making sure their customers can get free refills on those soups they got. That's what they were talking about on their earnings call. Got to promote the value. That's what happens. As prices compress and your ability to raise prices goes away, you got to make your customers feel like they're getting more value, so they keep coming back. That's why I wear Christmas sweaters, okay? Anyway, we're 2 minutes away from the minutes dropping. Again, it's all going to be a big old massage-a-doodle of rate expectations. That's it. And it entirely makes sense for markets to chillax a little bit on their enthusiasm. Oh, wow. Did somebody leak the frickin' minutes? What happened to the 10-year? Oh, that's weird. The 10-year this morning ran up to 4%. So it was up like 6 basis points or 7 basis points. Now it's down 2.6 basis points. It's back to 3.92. Weird. Anyway, minutes are about 40 seconds away. They always leak it. Yeah, somebody always gets it first, huh? So we'll see what happens. We'll see how the market reacts. Again, personally, just my opinion, okay? I got 30 seconds here for my opinion. Inflation's over. Prices are going to stay high. They're going to go right back to printing again. And interest rates are going to go lower in the next decade than they've ever been before. And markets will recover in a continued Nike swoosh as the recession continues to get kicked down the road. And they'll do that with money printing if they need to. Eventually, there'll be another glorious recession. Maybe it'll be debt-induced. But it ain't here yet. All right, here we go. All right. Okay. Saw upside to risk inflation having diminished. Inflation risk having diminished. Generally viewed addition of word any to comments as a possible additional firming as relying on their judgment that rates were likely at or near peak. A number of participants highlighted uncertainty around how long restrictive policy would need to be maintained. Okay, that's good. I'm just reading this off the tape. A few participants suggested the Fed could face a trade-off between the dual mandate. Participants observed progress on inflation and had been uneven across components. Noted some services prices were still rising at an elevated pace. In projections, almost all indicated that their baseline implied lower Fed funds rate would be appropriate by the end of 2024, so almost unanimous for 2024. Participants noted, however, that outlooks were associated with unusually elevated uncertainty. Several participants observed that circumstances might warrant keeping policy rate at the current level longer than they currently anticipate. Generally stressed the importance of maintaining a careful and data-dependent approach, reaffirmed it would be appropriate for policy to remain restrictive until inflation is clearly moving down sustainably. Several participants suggested it would be appropriate to begin discussing the technical factors around slowing the balance sheet runoff. Wow, we weren't even expecting that talk. What? They're talking about slowing the balance sheet runoff? Well, that's exciting. Really? Slowing the balance sheet runoff well before such a decision was reached. So starting to talk about it, basically, right? Several participants noted the decline in the use of the repo facility as reflecting portfolio shifts by money market funds. Economic outlook was broadly similar to the projection of the prior meeting. Okay, fine. Great. Now let's see if we can actually get into the darn thing here. It always does page not found for the first few minutes. So that's why I just read the tape for a while. But anyway, so several said rates could stay at peak longer than anticipated. Okay, that's not a surprise. Acknowledged projections show cuts by the end of 2024. That's fine. Not a surprise. Come on, give me the freaking minutes. Okay, let's see. Officials saw the policy rate at or near peak. We rated that already. Scanning the initial headlines. This one looks, quote, more hawkish than Powell had indicated during the presser. Ooh, more hawkish. Noted that several participants thought the benchmark rate could stay at peak for longer than anticipated. In other words, pushing out the first rate cut. I can't get the stupid minutes. This is so dumb. Give me the minutes. Looking at others. Nope, no real big movements anywhere yet. Still page not found for multiple different sources here. A lot of people having this trouble, it looks like. Okay, looking for other updates here. The market so far isn't really reacting. Let's take a listen in if CNBC has it.
Vice President Ken, welcome. Good to have you with us. Do you still feel, based on what you just heard Steve say, that rate cuts are a matter of when, not whether?
By the way, he read the same tape I did, basically.
I absolutely think that there has to be some rate cuts. What I worry about...
Looks like mixed messaging. Rates could stay higher than expected, but there could also be cuts by the end of the year. Several policymakers stay at peak longer. We saw that slight pairing of gains in the 10-year Treasury. Those yields now flat from being down 2 basis points. Surprised we don't have a bigger reaction off the initial bank of headlines, the ones that I read off. Yeah, there's very little reaction. Probably because nobody can read the damn thing. All right.
They would be coming down too fast because the market would be anticipating that the economy is in some distress, sputtering.
That's exactly right. If we start seeing, this is the time to stress test. This is the time to take a step back and say, we've got a lot going on in the world today.
Yeah, like all the suits are like, not a ton of stock moves in the wake of the release. Market reaction is limited so far. Where is the form?
Savings rates go down. I think this is the time that we do a little bit of a stress test and a little bit of election protection here.
How do you do it? What do you do?
So instead of betting how quickly rates are going to go down, let's just say that we think the long term is positive. And with that in mind, let's do a little hedge. Let's do a little downside protection. Let's do something that's going to protect if the overall market goes down. Days like today where we're seeing volatility, why are we afraid of that? It's going to happen. Why don't we embrace that? Have the cash available. And I do think, and I think this is similar to your last guest, Kelly, I think this is a balance. Could the Magnificent Seven still rise? Yeah. But why not go into more interest rate sensitive healthcare names, financial names? Why can't we start broadening back the portfolio out?
You can. Some people are just afraid to because they don't want to underperform again or they want to stick with tech. Let me just circle back in a moment. If I can just go back to Steve Leisman on the minute. Steve, the market initially had a knee-jerk reaction to the downside. We're stabilizing somewhat here. How much should we read into this idea that maybe you can put it better than me, they weren't exactly gung-ho in the discussion, at least, about cuts. It was more in the projections?
I want to go a little off topic here.
Sure.
This all reminds me a little bit of Bruce Springsteen line where it says, take a right at the light, go straight into the night, and then, boy, you're on your own. To the extent the market is forecasting 6 rate cuts next year, or this year, sorry, it's on its own. These minutes do not back that up, would be my personal opinion here. I think the minutes are backing up this idea that there's likely to be rate cuts this year. Those are in the projections, but that the extent to which the market has that certainty, and I did see it, by the way, in the probabilities in the last couple of minutes, back off just a touch. It's still a 70% probability of a rate cut coming in March. But that is something the market has to own on its own. and cannot really point to the Fed to come to that conclusion. And it's okay. It's not wrong if Ken, for example, wants to advise his clients, hey, the Fed is going to cut rates in March and do so 6 times because my inflation forecast is X. I don't think you can go back to the text to support that conclusion.
Yeah, so the words do seem a little bit more like they're holding back. They are indicating that the sort of the peak of this cycle, Steve, has been reached, but they're not really committing, at least verbally.
No, and like I've said, Tyler, it's okay to have that conclusion, and that could be the right conclusion. There's no, the Fed doesn't have any lock on getting forecasts right, and God knows it may actually have a lock on getting them wrong sometimes. But that said, if you do this on your own recognizance, essentially. You go out there and you say, okay, I have this inflation forecast that comes down to the point, and this is the key point here, that it provides the Fed the confidence that it says in this document it needs in order to cut rates, and that's going to happen between now and the March 20th meeting.
So, Ken, you mentioned a couple of sectors that you think are well positioned for defense. Let's go back through those a little more slowly, and obviously there are big sectors.
On.
Finance is a big sector. There's
This is like ridiculous. I cannot get these freaking notes up.
big banks. There are medium-sized banks. Healthcare is vast.
That's right.
So where within those sectors?
And also what Steve said is super important. I don't think that the market necessarily needs to decide, I think rates are going down in March. I don't. And I think the things are very dynamic right now. If, for example, we...
Got it. I'm just going to use a freaking iPhone. God. Okay, so let's see what we got here. Here, I'll put that on Do Not Disturb really quick. Okay, so what do we got? All right, so here we go. Manager, turn. You guys can't read this. This sucks. They could just give her a freaking iPad. This is such trash. Sorry, folks. It took forever for them to show up here, and now I can't get it up. My bad. I'm going to start reading it, though. All right, so... freaking trash. All right, so I'm going to start going through it. Sorry for the delay. The manager turned first to the review of developments in financial markets over the intermeeting period. Financial conditions eased, driven by a decline in interest rates. We already know that. What I really want is just to be able to start command effing through this, though. So let's just give it a second here and get in so we could just airdrop this over and have it already, because there's no point to just trying to read the whole thing. We need to command F. So far, I'm reading what the suits are saying, too. No signs of imminent cuts. Policy makers say their projections imply reductions would be appropriate by the end of 2024. Several suggest rates could stay at current levels for longer than they anticipate. Oh, my gosh. Final freaking Lee. Good Lord. I'm so sorry. That is so exhausting. The benchmark rate was seen at likely near peak, though officials note that further rate hikes remain possible if the economy wants. That's all boring. I want to read it myself, because if I read it myself, we're going to get a little bit more color than just this nonsense from the suits. Finally! God. All right. So what we're going to do is we're going to start with rate. Let's get the term rate and rate, policy rate. Okay, here we go. Treasury securities over the period attributable to a reduction in term premiums, about 1/3 to the decline in expectations for the policy rate, whatever. We've got pricing of inflation derivatives over the intermeeting period suggest investors have become more optimistic about the near-term inflation outlook. That's true. Okay, Fed funds rate for tightening cycle had been reached. Let's see, peak. This was, the survey suggested that peak had been reached. That's fine. Overnight repo rates continue to experience some modest upward pressure over the period. That's fine. The manager expected that private market repo rates would likely remain above the rate offered. That's fine. Come on, give us some data here. Unemployment rates. We talk a little bit about the economy here. Unemployment rate was little changed, 3.7%. This is just sort of reiterating what's going on in the markets. That's fine. Let's get a little further into this. So let's go over here. Okay, in October, PCE growth slowed from its average monthly rate in the third quarter. As for business investment, nominal shipments of non-defense capital goods essentially flat in October. Residential housing starts moved mostly sideways. Home sales continued to fall. Manufacturing production declined in October. Factory output was weak after excluding the decrease in motor vehicle assemblies. fine. Most major foreign banks kept their policy rates unchanged. I think the Fed's going to lead this down, though. Spread financing conditions remain modestly restrictive. That's okay. That's kind of what you would want. Straight read of the Fed funds rates suggests markets expected a 25 BP cut by May. That would be like fully pricing in by May. It is fully priced in by May. That is true. The policy rate path implied by overnight swaps moved down 45 bips to 4.2 by the end of 2024. Treasury yields declined significantly. The decline in nominal yields was reflected by a decrease in real yields. Fine. While measures of inflation compensation were moderately lower, broad stock price indices increased markedly over the intermediate period. So they're acknowledging the stock market had gone up because of declining yields. Conditions remained stable for funding. Rates had declined in the intermediate period for cars and housing. Credit quality remained broadly solid but deteriorated further. Oh, that's interesting. Let's get into right here. Look at this. Credit quality remained broadly solid but deteriorated further for some sectors. Delinquency rates on non-farm, non-residential, commercial real estate bank loans rose further in the third quarter, and delinquencies for construction and land development as well as multifamily loans ticked up. Wow, that's actually kind of interesting. Multifamily tick up as well. I'm surprised by that. I think there are going to be a lot of opportunities there in multifamily, less so in single family, unless you know what you're looking for. After increases over the first 3 quarters, delinquency rates for CMBS edged lower, but large volumes of loans moved to mature over the next few quarters suggested that delinquencies would likely surge again. Yeah, this does not sound good for commercial real estate, including multifamily right here. So they're definitely observing some pain over here. Delinquency rate for small business loans continued to tick up in September, was above levels observed before the pandemic. Credit card delinquency rates also increased further, while delinquencies on auto loans were little changed. Trailing default rate for investment and speculative grade corporate bonds, little change, fine. Staff economic outlook, here we go. The staff continued to expect GDP growth would grow slowly in the fourth quarter from its outsized third quarter growth, but that growth for 2023 would remain solid. The lagged effects of earlier monetary policy, I like hearing this kind of stuff. The lagged effects of earlier monetary policy through their contributions to continued tight financial conditions and credit conditions were expected to show through more fully in restraining economic activity in the coming years. Real GDP was projected to increase more slowly than the staff estimate of potential for the next 2 years, before rising in line with potential in 2026. So in other words, slow economy here potentially between now through 2026. Unemployment rate was expected to be roughly flat through 2026. Staff revised down their inflation forecast, reflecting lower than expected incoming data. Okay, that's good. Lower than expected inflation. So they're revising down their inflation. They're talking about the SEP, and they're referencing that pretty fairly here. Staff continued to view uncertainty. Yep, we already know that. In conjunction with the Fed meeting, we have the projections. Here's the SEP talk. We don't need to reiterate that because we already remember it. Supply and demand factors affecting inflation so far. They assess the contribution of improved supply, boost to labor supply due to higher labor force participation and immigration. We're still down about 0.5% on labor force participation, by the way. They also noted that restrictive monetary policy had helped restrain growth of demand, particularly in interest rate sensitive sectors such as housing and autos and other durable goods. It's literally like Tesla and Enphase. Several participants assessed that healing in supply chains and labor were largely complete. That's an interesting line. Healing in supply chains and labor were largely complete. And that's where there's that potential risk in continued inflation coming down, slowing. And therefore, that continued progress in reducing inflation may need to come mainly from softening in product and labor demand. See, that's not great. Continued progress may need to come from product and labor demand. Basically meaning, this is why we might have to keep restrictive. So that's not good. That definitely does come across as a little bit more hawkish. In their comments about the household sector, participants observed that consumer spending had been strong, supported by healthy balance sheets, right? So still room to basically crush the consumer, so to speak. Okay, let's see. Participants assessed that while the labor market remained tight, it continued to come into better balance. Many noted that nominal wage growth had continued to slow broadly, and business contacts expected further reduction in wage growth. That would be right here. Few participants observed that payroll growth had slowed substantially since the beginning of the year. Some participants remarked that their contacts reported a larger applicant pool for vacancies. Okay, so more people applying. So just basically a softening in the labor market. In their consideration of appropriate monetary policy at this meeting, participants noted indicators suggested that growth from economic activity had slowed from its strong pace in the third quarter. Job gains had moderated, but had remained strong, and the unemployment rate had remained low. And there were continuing signs that supply and demand in the labor market were coming into better balance. Inflation had eased over the past year, but remained elevated. Participants noted that tighter financial and credit conditions facing households and businesses would likely weigh on economic activity. Yes, they would. Okay. To the extent, basically committed to being at 2%. Fine. Okay, here it. In light of the current circumstances, they maintained at 5.25%. Okay, we know that. Participants assessed that maintaining the current policy stance was supported by intermediating data that inflation had continued to move towards the committee's 2% objective. They judged that maintaining the target rate for the Fed funds rate after this meeting would promote further progress towards the committee's goal. Right? That's basically the higher for longer piece. The longer part, specifically. In discussing the policy outlook, participants viewed that the policy rate was likely at or near peak. Yes, we pretty much already know that. Participants pointed to the decline in inflation seen in 2023, noting that the recent shift down in the 6-month inflation readings in particular, and growing signs of demand and supply coming into better balance in the product and labor market, had informed this view. Several participants remarked that the committee's past policy actions were having their intended effect to slow growth in aggregate demand as well as cool labor conditions. They judged that in combination with improvements in the supply situation, those developments over time were helping bring inflation back to 2%. Most participants noted, as indicated in their submissions, they expected the committee's restrictive policy stance to continue to soften household and business spending, helping promote further reductions in inflation over the next few years. In their projections, almost all indicated that their baseline projections implied a lower target for the Fed funds rate for 2024 would be appropriate by the end of 2024. They noted, however, that their outlooks were associated with an unusual elevated degree of uncertainty, and possibly that the economy could evolve in a manner that would make further increases in the target range appropriate. So notice how they're talking more about the potential for increases rather than the potential of cuts. Several also observed circumstances might warrant keeping the target rate at the current value for longer. But I want several talking about cuts, not up or keeping. Participants generally stress the importance of maintaining a careful data-dependent approach. Notice they totally cut out so far. Like literally, I just write this down. So far, no references to cutting, which is massaging. Purposeful massaging. They might not want cut in March. They might want May. So I'll write that down. So I have this little note here. That's kind of what this is implying. This is implying like, hey, we're probably more realistically a cut in May, unless some poopy doopy hits the fan or whatever. So this is not really supportive so far of a 25 BP in March. Participants discussed several risk management considerations that could bear on future policy decisions. Participants saw upsides to inflation, but noted that inflation was still well above. Fine. Number of participants highlighted the uncertainty of how long a restrictive policy stance would need to be maintained, and pointing to downside risks. A few suggested that the committee could potentially face a trade-off between its dual mandate goal in the period ahead. Okay. But notice, completely cut, no mention, purposefully cut out cuts. Purposefully removed mentions of cuts. In other words, the market went too far. Okay. What else? Maybe you could spell correctly. There we go. Participants observe, and by the way, after this, I'll put this entire PDF on eHack so you have a link to it once we're done with the stream. Participants observed that continuing progress of reducing the Fed balance sheet was important. Okay, several noted that normalization was important. Blah blah blah. Remember, we already read on the tape that they would start talking about formulas for potentially slowing the pace. Yeah, here's slow the pace of the runoff. Start discussing that well before they actually plan to. That's fine. Banking system sound and resilient. Target still 2%. I mean, none of this is a surprise. Yeah, this is pretty blunt. I think so far this is a very blunt way of the Fed saying, y'all priced in a little too much for us. And let's see, Treasury yields right now on... Yeah, why... You know, why the headline is from CNBC, for example, is, oh, you know, path uncertain. No, duh. They say the same thing every time. But anyway, the 10-year yield right now is still down 2 basis points. So, you know, nothing to sort of undo the madness that we've had in the last few days here in the market. If anything, this sort of reiterates the market unpricing the March cut. Let's get some more words here. I'd like to see if we have any GDP mentions. GDP. Relatedly, several participants noted weakness in GDP. Gross domestic income growth relative to GDP over the past few quarters suggests that economic momentum during the period was not as strong as indicated by GDP. Ah, interesting. So you have some people saying, hey, you know, the GDP numbers are misleading. Let me see what some of the suits are saying. Sometimes I can get some words to look up from them. GDP growth would, no, that's fine. Let's also try recession in just a moment here. All right, let's try recession. No recession mentioned. And then if I look for the word soft, as in like soft landing, they just talk about softer than expected data releases, softened household and business spending, softening of growth of the labor market. No mention of soft landing. Okay, it's fine. Reaffirmed. Yeah, I want to get the reaffirmed part. That's a big line. Yeah, I remember reading this. That's the paragraph. That's the poopy paragraph right here. Participants generally stress the importance of maintaining a careful and data-dependent approach, and reaffirmed it would be appropriate for policy to remain at a restrictive stance for some time. Not great. I'm shocked so far. I mean, maybe I'm not, but they basically cut all of the mentions to rate cuts out of here. With the exception of, you know, by the end of 2024. Several participants felt that policymakers ought to start talking about the slowdown well before the decision is reached. That's fine. Fed says, okay, let me see here. Remember, by the way, I'm live every single day. The market is open at 5:25 a.m. on this channel, so join me if you haven't already. But anyway, as for labor demand, continue to move gradually into better alignment. Powell had indicated at the press briefing policymakers didn't want to take the possibility of further rate hikes off the table. Well, that's true. I mean, they're not going to say... It's totally reasonable for them not to say, oh, yeah, we are going to, you know, definitely not raise rates again. Of course they're not going to say that. So that's not a surprise. That doesn't bother me at all. Okay. Next we have... Okay, let's see here. There's been a brief flick at China in the minutes. Chinese economic indicators such as retail sales and industrial production pointed to economic growth remaining modest. Oh, well, yeah. Duh. Okay. Some mild pushback against the exuberance in financial markets. Yeah. That's the easing of financial conditions part. See, this is a fight. They're fighting internally about the easing of financial conditions because really what happens is if you ease financial conditions, you risk limiting the Fed's, the whole purpose of having rates high. I mean, consider for a moment if you, you know, if the market doubles, let's just go extreme, okay? Let's say the market just doubles. Every stock doubles tomorrow. you're not really supporting a tighter economy. You're supporting a way looser economy. A way looser economy that is likely, by at least bears, to be deemed as inflationary. I personally don't think that a stronger economy is necessarily an inflationary economy, especially since that's not what we've been seeing at all, including the data that came out this morning. But that's okay. So specifically, that would be here. This is where we have that. The easing in financial conditions reversed some of the tightening that occurred over the summer and much of the fall. Wow. Wow. The rise in equity prices was supported by the decline in treasury yields and earnings growth that exceeded consensus expectations. Yeah, right here. This is basically the Fed saying, yo, y'all went too far. It's not that bad of a report. But it's like a little slap on the wrist so far, okay? It's like, no. Not so fast. I do think they're trying to unprice March. I think they want more time before they cut. Several observed rates maybe need to be kept at this level for longer, less specificity regarding participants, flagging a potential earlier than expected rate cuts. A few suggested there could be a trade-off between employment and price stability goals. Yeah, definitely a hawkish bias. Let's see here. The eventual tapering, we covered that. The doves are more worried about the labor market weakening too quickly. Absolutely. That is, the Fed needs to be heavily careful because they could push us into a nasty recession. And then I will flip-flop fast. Where is that? Where do they see that? Here? No, this is labor demand were to. Labor demand were, here it is. Several participants noted that the risk, if labor market demand were to weaken substantially further, the labor market could transition quickly from a gradual easing to a more abrupt downshift in conditions. Correct. If you are a bear, that is what you are looking for right now. If you are short, I'm going to make this red. If you are short, that's what you need evidence of. Because if you crush the labor market, we're done. We're going right back into like an 08 and it's going to suck. And people are going to be like, no, but then prices will be lower, get some deflation. You're right. You'll get your deflation. You'll also get your deflation in your pay because you'll lose your job. And you get your deflation in your car because you lose your car. And then you get your deflation in your house because you lose your house. It's terrible. You should not wish for such things. Unless you're short. Then you can buy a jet. If you're right. Fed staff updated their economic projection. Yeah, we already know that. One takeaway is that they anticipate U.S. growth will run below potential rate over the next 2 years, only getting back to potential in 2026. Ha! That's what I found. They picked that up from me. Thank you very much. A shift in the balance of risks seen by the FOMC policymakers in the minutes. Participants saw upside risks to inflation as having diminished. No way! Oh, that's a great line. Wait a minute. What? Holy smokers. Wait a sec. Upside risks to inflation as having diminished. Oh, it's right here. Oh, so we read this. Participants discussed several risk management considerations that could bear on future policy decisions. Participants saw upside risks to inflation as having diminished. Oh, that is a sexy line, actually. Oh, that's hot. I like that. Ooh, I'm going to print that one out and put it on my refrigerator. But specifically just that part, not the but. I don't want but. Overall, it was a hawkish update from the Fed, but the 10-year nonetheless pretty much unchanged. Goldman Sachs Financial Conditions Index down. That's fine. It hasn't moved that far down, though. These freaking babies. Let me see. Goldman Sachs Financial Conditions Index. Oh. Okay. Yeah, it did fall quite a bit, actually. Oh. Never mind. Hold on. I show it to you. They did actually fall quite a bit. So yeah, the Fed's not wrong here. But I want to show you the 10-year history of this Goldman Sachs Financial Conditions Index. But it did have a nice little droppy doodle. I'll show you that in one moment. All right, let's try to get this to come up. There we go. By the way, if any of this stresses you out, you can still get life insurance in as little as 5 minutes by going to metkevin.com/life. Yeah, it's a paid sponsorship. metkevin.com/life. Beginning of the year is when most people sign up for life insurance, by the way. I didn't know that. I was told that. I guess it's like part of like a New Year's resolution thing, is like death insurance. That's what it should be called. I'm not supposed to say that. Whatever. All right. Here we go. So these are the financial conditions. Let's draw on this here. So this plummet right here is what the Fed's pissed off about. Let's zoom in a little bit. Oh my gosh. Okay, I'm going to throw this iPad out of the window today. There we go. This giant plummet over here is what they're concerned about. And if we look, let's go ahead and draw a line across here. Let's go with this. Let's kind of see that level. There we go. That's our level right here, which means if we, basically all of the tightness, let's see what this date is here. I think that's August of 2022. It is June of 22. So, wow. That was like the bottom of the SPY, I think. June of 2022 is right there. So consider that for a moment. If we go look at the SPY, SPY, and we go out to the week chart, and we jump over to it, where was our bottom? Our bottom in the stock market, there. This is June right here, right? The bottom was October. So this is near bottoms. This is S&P down from where we are now, 371 divided by 471, let's say, down about 21%. So SPY down 22% from here. That's not saying it's going to drop 22% or whatever. That's just comparing to what the financial condition tightness level is at now. So financial conditions are as loose as they were when the market was basically at bottom. Okay, all right, fair. I get it, Fed. All right, so back to the minutes. All right, that's not a bad one. This is fair. I don't think any of this is that bad so far. I do think it's a little lame that they cut out all the talk about cuts, other than by the end of the year. It's because they wanted this to be a little hawkish. Not a lot, but a little. Both camps can claim victory from these minutes. If you're in the rate cutting camp, then the minutes confirm some Fed policymakers are thinking about hitting reverse. If you're in the higher for longer camp, the minutes make it clear that rates are going to remain restrictive for some time. Yes. That sounds like ChatGPT wrote it. The Fed staff, in their review of the financial sector, warned that given the large volume of commercial mortgage-backed securities coming due in the next few quarters, delinquencies could likely surge again, anticipating escalating troubles in commercial real estate. That right there, it was like not good. Like if you want to make a bearish real estate video, right there, baby. Page 5. Fed calls for real estate crash. Where's the surge? Surge. There it is. Delinquencies would likely surge again. But that's an opportunity. It's Christ-opportunity. Go buying. Let's see here. What else? S&P trimming losses. Oh, are we really? Yeah. A little bit. All right, I think the Fed got what they wanted here. Let me see if there's anything else juicy in here. I think we pretty much hit it. But let's see. Let's listen to CNBC for a second.
And New Orleans. Here to discuss in today's Tech Check is Duncan Davidson. He's co-founder and general partner.
No, I don't really care about this. Minutes participants suggested it would be appropriate for the committee to begin the technical sector. Yeah, that's fine. Technical discussion for that's fine. Easing could make it more difficult for the committee to reach its inflation goal. Exactly. That's a line I think a lot of bears are focusing on right now. And that is right. There are two of them. There's this mention, the easing of financial conditions reversed some of the tightening that occurred. And then there's this one. Many participants remarked that an easing in financial conditions could make it more difficult for the committee to reach its inflation goal. Could. Powell. What? Somebody says Powell coming live? Oh, where? I see no Powell. If Powell was live, wouldn't people be covering him? No, Powell doesn't go live today. There's no Powell scheduled today. Y'all silly in the comments. Okay, what else? No. Fed officials forecast policy remaining restricted for some time. We saw that. I mean, these are then you just get the tape. Yeah, it's boring. Now, that's it. That's boring. Kind of boring. I'll do a summary here really quick, just to give you a bottom line, and then we have a recap of it. Okay. So, let's do that together. All right. Take a little sippy doodlah here. I just locked in my 7% mortgage to troll my lender. Joke's on you. Okay. Here we go. Oh, I gotta hit record. So what did the Federal Reserve's rug pull have in store for us today? Well, they started off very, very quickly by making it clear, exceptionally clear, that the rise in equity prices was supported by a decline in Treasury yields and earnings growth expectations that exceeded the consensus, and that financial conditions reversed some of the tightening that occurred over the summer and much of the fall. In other words, the Fed's like, yo, we got a job to do here, and y'all potentially making it harder with your frickin' loosening of financial conditions out here, and you're pissing us off a little bit. So what did they do? What did they do to punish us? To give it to us a little dirty? What'd they do? They removed almost all mentions to rate cuts. They sanitized it. It's like they took the minutes and poured rate cut bleach over the minutes just to eradicate it. The only juice the rate cut camp got was that maybe rates would be lower by the end of 2024. That's it. But the hawks got a lot more attention in this one, especially since there was concern that right here, many participants remarked that an easing in financial conditions beyond what was appropriate could make it more difficult for the committee to reach its goal. Not only did we hear this, but then the Federal Reserve wanted to do a dirty hurdy for anybody thinking about buying the dip in commercial real estate. Because the Fed just either gave you a green light to go shopping or gave you a green light to sit on the sidelines because you're scared and you don't want to catch a falling knife. That's because when you pop on over to page 5 of the minutes, what you got is credit quality remained broadly solid. But some sectors deteriorated further. You want to hear which one specifically? How about delinquency rates for loans and commercial mortgage-backed securities? Which, yes, the rates edged lower in October because, they do that. I guess they edge down in October. Ready for this? The large volume of loans scheduled to mature over the next few quarters suggests that delinquencies would likely surge again. The delinquency rate for small business loans continued to tick up and was above levels observed just before the pandemic. In other words, and you got credit card delinquency rising. So in other words, stress is rising. The cracks of real pain are forming. In fact, the biggest contribution for the doves or the people trying to be bullish are the concerns that the labor market could flip. Labor market flipping would be your biggest issue. And this has to do with the two sides of the Fed's dual mandate. That was mentioned right here on page 8. A few suggested that the committee potentially could face a trade-off between its dual mandate goals in the period ahead. That's the one really dovish line you got here. You got commercial real estate is about to hit a poopy doopy, including in multifamily. Okay, that I thought was very interesting, that they mentioned multifamily right here. Delinquency rates for construction and land development, as well as multifamily loans picked up. It's a big deal. So the doves got a little bit of a mention that, hey, look, we're aware we could screw up the labor market. And we're starting to see data like that. Remember what Paychex warned? It was a massive warning from Paychex. Paychex like, yo, usually we get seasonal hiring. Where the hell is seasonal hiring this winter? Paychex is a payroll processor, okay? And what happened was HR firms didn't hire as much staff to work seasonal hiring because there was less seasonal hiring, which is an early indicator of stress in the labor market and potential cracks. Problem is, you don't want to wait for unemployment to start really going up because, as we've heard and studied in history, when the unemployment rate goes up 1%, it tends to go up another at least 1% thereafter. So in other words, if we want to go from 3.7 to 4.7, we're probably going all the way to 5.7, if not even worse, because then you're on the train of unemployment. It's kind of like once you start down that path, it's coming. Unemployment's coming. It's bad. That's mostly because one person laid off leads to the cycle of unemployment. People losing their jobs, their homes, their cars. So when they lose all their crap, what happens? They stop spending. When they stop spending, a bunch of other people end up getting laid off. It's a bad cycle. I don't think the Fed wants to go in that direction. I think the Federal Reserve here is really just pissed off because of this. All y'all in the frickin' markets screwed up financial conditions. And you pushed financial conditions all the way down. This is the Goldman Sachs Financial Conditions Index. All the way down to the same tightness of financial conditions we had when the SPY was down 22% from now in June of 2022. The red arrow. That's how low financial conditions are now, how loose they are right now, okay? Lower means looser. That means lower yields, higher stock market, in this case. But back then, we were really just starting the whole tightening cycle. That's why we were kind of on the uptrend then as the stock market was going down. And now we're loosening on the right side because rates are so high and the stock market going up is kind of pushing it down in that direction. It's the balancing factor. There are like 7 different things that go into financial conditions. The point is, the bottom line is financial conditions are as loose today as they were when the stock market was going, oh my gosh, we're just getting started with the tightening in June of 2022. Remember, we started tightening in March of 2022. See how straight up that line went right there? Yeah. So this is where the Fed's like, yo, what are y'all doing? You're undoing the work we're doing on inflation, and this creates a risk that we might not end up keeping inflation down. Specifically because they believe that supply has done most of the work so far on inflation. And unfortunately, if supply has done most of the work on inflation and the supply levels of supply for goods and services and labor are more in balance now, then getting the rest of inflation down or the rest of the levels of inflation down would be a lot harder. In fact, take a look at this specific mention right here. They assessed the contribution of improved supply had come from supply chain normalization, boosts to labor supply due to higher labor force participation and immigration, better productivity growth, or increased domestic oil production. They also noted that restrictive monetary policy helped restrain growth of demand, particularly in interest rate sensitive sectors such as housing and autos and durable goods, like solar panels. Several participants assessed that healing in supply chains and labor supply chains were largely complete. Well, if that's complete, then what do they say after that? And therefore, continued progress in reducing inflation may need to come mainly from further softening in demand, which in other words means we need tighter financial conditions. So you have a Fed that's aware they could very easily screw up the labor market. But not only are they aware they could very easily screw up the labor market, they're also aware they could very easily screw up the multifamily and commercial real estate market. And so they're providing warnings on this. They're also warning that essentially those lower income households or those with credit card debt are facing delinquencies more frequently. So they're making it known that we see the risks, and as they address those risks, they're looking at everybody in the market going, you know, y'all just shooting yourself in the foot. You're making it harder for us to get inflation down. You're undoing our work here. I personally don't actually think that's necessarily true. That's what the Fed is trying to argue here. That's why they sanitize the minutes of rate cut comments. I think they're trying to buy themselves more time, and they're trying to push back the March rate cut. That's my bottom line on this. I think they're trying to push back the March rate cut because the market was pricing in with about a 68% level of certainty we were going to get a rate cut in March. That's what we were pricing in. Markets right now have it at about 67%. So markets so far have only really unpriced it by about a percent. That's because the numbers weren't really that hawkish. There's actually a 5% chance in that we get a whole 50 basis point cut in March. But I think as we get closer to the January Fed meeting, J. Powell might kick this can down the road to May, and it could mean some more short-term pain in the stock market, especially as we wait for more catalysts to play out, like CPI next week, earnings thereafter, and then obviously J. Powell on the 31st. So, is the Federal Reserve concerned about commercial real estate blowing up and the labor market going poopsie-doopsie? Absolutely. Are they, though, also a little concerned that the hard part of getting inflation down is still ahead of us? We don't have enough time yet to say we're done? Yes. I think they're done. Again, that's the Fed. My opinion is they're done. They've probably already gone too far, and they screw up the labor market anymore. I'm selling and I'm taking a vacation. So far, with the data we got this morning on the labor market, it doesn't sound like it's time for Kevin to flip-flop just yet. So we could still be okay. And if they engineer this soft landing, I remain committed to the idea of building a statue of Jerome Powell in my front yard. Because I think that's what they're going for. They will print their way right out of a labor market pain. It will happen so fast. In fact, nobody ever said we need 25 basis point cuts. As soon as they start seeing that labor market stretch, cut, and then print. They've already laid the groundwork to talking about slowing their balance sheet runoff via the reverse repos, basically the selling of bonds and then burning of that money. Crazy. So, that's my take on the Fed minutes. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than House Act, nor am I presently acting as a market maker. Oof. Yeah, some big, painful drops over here. A firm down another 5%. Honestly, we've been talking about this one in the Market Open Live, about it being a tempting short, along with Costco, which I am short Costco. And Coinbase upon ETF approval, but honestly, I was not expecting it to plummet on just the rumor that the ETF would not get approved. Anyway, how did yields finish up? And then let's get the heck out of here. Yields finished at, down, no way. Down 3.7 basis points. Yup. So not hawkish enough to push yields back up. By the way, I'm going to post my entire PDF in about 2 minutes on ehack.com. All right? See you there.